Thank God it's Monday, because it means we have 5 fresh days to discuss current and relevant business issues here on Business Morning. Good morning and welcome. I'm Ini John Mekwa. Let's dive right into it this morning, beginning with oil prices that were mixed on Monday as investors balance expectations that OPEC will cut output to support prices against concerns sparked by Federal Reserve Chairman Jerome Powell saying that the United States will face slow growth for some time. U.S. West Texas Intermediate crude futures rose by 2 cents to $93.08 a barrel. Adding to Friday's gain, Brent crude futures were down 27 cents at $100.72 a barrel, trimming gains from the previous session. The dollar index continued to climb on Monday to $109.16. That's up 0.3% in early trade. A stronger dollar weighs on oil as it makes crude more costly than other currencies. However, oil prices have been buoyed by talk from Saudi Arabia and other members of the Organization of Petroleum Exporting Countries and its allies that they could cut output in order to balance the market. United Arab Emirates is aligned with Saudi Arabia thinking on output policy, and this are some of the factors that are affecting the market this morning. Well, looking at another market now, the grains market, Chicago corn futures rose for a second session to their highest in 2 months after a U.S. crop tour forecast lower production following hot and dry weather, and this has raised concerns over global supplies. Wheat gained more ground while soybean fell. The most active corn contractor on the Chicago Board of Trade, CBI, was up 0.7% at $6.69 a bushel after climbing to its highest since the 24th of June, which was $6.74. Wheat rose 0.3% to $8.07 a bushel, and soybeans lost 0.8% to $14.49 a bushel. ProFarm predicted a soybean crop of 4.535 billion bushels, slightly bigger than the U.S. Department of Agriculture forecast for a record of 4.531 billion. Lower U.S. corn production outlook is adding to concerns for tightening global production of grains, including wheat and rice. Advisory Service PRO Farmer projected a U.S. corn harvest of 13.759 billion bushels, which will be the smallest since 2019 and below government forecast of 14.35. And then we move to Nigeria now, see what's happening back home. The Central Bank of Nigeria has released $265 million to airlines operating in the country to settle outstanding ticket sales in a move to save the aviation sector. We do know this has been in the news and a source of concern in a while. Well, this comes as a huge relief as some airlines have threatened to withdraw their services in the face of unremitted funds. Emirates has threatened to start that in the 1st of September. That's on Thursday. According to CBN's Director of Corporate Communication, Mr. Osita Wasinobi, the bank is concerned about the brewing crisis in the aviation sector and what it portends for travelers. Mr. Wasinobi also stresses that the bank was not against the repatriation of funds from the country, but wants an orderly exit for those that may be interested in doing so. And still in Nigeria now, let's cooperate and re-strategize on standards to protect businesses in Nigeria. That's coming from the Director General of the Standards Organization of Nigeria, Mr. Farouk Salim. Mr. Salim was the guest at a meeting organized by the Apapa sector of the Manufacturing Association of Nigeria.
Manufacturers from the Apapa area of Lagos, top hierarchy of the Standards Organization of Nigeria, and the Manufacturers Association of Nigeria are gathered in this hall. They are present to discuss standards for competitive manufacturing in a continental and global market. First, the challenges were the unique environments that gives no room for growth.
The last business year has been quite challenging. It was particularly daunting for the manufacturing sector due to a number of oft-repeated challenges like infrastructural deficiency, insecurity, forex illiquidity, inflationary pressure, weakening purchasing power, multiple taxation, port-related issues, to name but a few.
Ahmed, for his address.
For the president of MAN, Mansur Ahmed, manufacturing in the country is still way behind and needs to do better.
Our manufacturing sector is weak because it is dependent on imported materials that we then process to produce. And we must therefore scale up or scale down, whichever we want it, our manufacturing so that we go back and transform and do the transformation process ourselves. If we can transform our crude oil into finished petroleum products, we will not have to rely on massive quantities or massive amounts of foreign.
The guest speaker, who is the Director General of the Standards Organization of Nigeria, Mr. Farouk Salim, says the agency is prepared to collaborate with manufacturers to enhance their access to the continental market.
Let's have a relationship. Let's re-strategize. Let's get a proper standard of engagement for all of us. Because our industries are closing every day because of substandard goods that are imported.
For the manufacturers here, this meeting has presented a vivid picture of the current realities, but also showcased many workable survival strategies for businesses.
Are we good? All right, thank you.
Well, other than that, one of the big news in Nigeria is the GDP figures that was released on Friday, and the 3.54% GDP growth of the country in the second quarter of 2022 amidst global headwinds is an indication of resilience. That's the observation of the Chief Executive Officer for the Center for Promotion of Private Enterprise, Dr. Muda Yusuf. Dr. Yusuf, after looking at the details, says it underlines the dominance of the non-oil sector, which accounted for 93.67% of the GDP, while the oil sector contributed just 6.63%, and this is in spite of the fact that the oil sector continues to play a leading role in the generation of foreign exchange and a significant role in the generation of government revenue. A lot of people have said this is a contradiction, but we'll drill down on this with the Managing Director of Optimus by Afrinvest, Mr. Ayodeji Ebo, joining us virtually now from Victoria Island to share his thoughts on this and some of those observations. Good morning, Mr. Aibo. Happy Monday to you. Thank you for sparing some time for us this morning.
Good morning. Thanks for having me.
Yes. So 3.54%, I think from 3.11%. And a lot of people are applauding it. But there are also some questions. For instance, how did we make it through? In spite of all we are recording, inflation at over 19%, the Forex, the FDI threatened, you know, the issue of insecurity also affecting manufacturing and the agriculture sector. How did we make it through from your perspective?
Okay, thanks. I would say, yes, it's a positive one, 3.54%. But there needs to be, we need to know that there's an optimal level that we need to achieve for us to easily see that impact on the populace. So 3.4% may look like, yes, very impressive looking at where we're coming from in 2020, 2021. But we need to, for us to be able to see that meaningful impact in the economy, we need to be able to attain a level around 5% and above before we can see that impact and the populace can really feel the effect. So business activities truly has opened up, and what we're seeing is like we're just scratching the surface, because amidst a lot of challenges that businesses are going through, we can still see that production and increasing demand is increasing. But like you rightly mentioned, high inflation, it means that what would typically be demanding for will also reduce as a result of rising prices.
So are we saying that we are still feeling the impacts of the base year effect? Do I hear you say that?
No, not necessarily. So if you look at, if it's on a year-on-year basis, last year was at 5.01%. Yeah, so that effect is fading away. But what I'm actually saying is that for us to be able to see that meaningful impact, because for for those of us on the street, what we'll be asking is how much of impact am I benefiting from this increase in productivity? Because when you look at GDP measures the production, increase in productivity, and with real GDP, it shows that we actually produce more. That's taking away the impact of prices, that we actually produce more in this quarter compared to last year's quarter. So, but in terms of feeling that impact on improvement in standard of living, improvement uh, in the impact and growth of the economy, that is really still lagging behind, because yeah, we are just seeing that normal increase in production, but it, in terms of translating into income, is still limited because of the several factors that weigh significantly on the disposable income.
Okay, so that means that for Nigerians, for consumers, when you look at their welfare and then you look at their purchasing power, this is just a number.
Yeah, this is measuring production, so it's different from measuring the measuring the per capita income, like you mentioned. So yes, for our GDP is increasing, but how much of value are we getting from this GDP? You know, like when we talk about debt, government was always too quick to look at what's the debt to GDP ratio. But that GDP, what is it producing in terms of income? It's not significant. Yes, we are growing, but how much of value are we extracting from it? How much of impact? Even governments, how much of impact are they getting in terms of translating into revenue? Talk less of the private sector. So overall, yes, it's showing that we are producing more, but in terms of translating into naira and kobo, it's not that significant. And I would say that the 3.5% level is still below our optimal level, where we may begin to see that major impact that will translate into improved taxes for the government, improved standard of living for the populace.
So for you, that level would be about 5%, right?
Yes, between 5 and 7%.
Okay. All right. So now help us to understand this contradiction. Now, the oil sector is a major part of the economy, but it contributed just about 6.6%. And yet the non-oil sector, which is being, you know, like minimized, has contributed about 93%. Help us to understand that contradiction there.
Thanks. And like we always say, Nigeria is well diversified. It's our revenue base that is not diversified. So you can see that the non-oil sector is what is driving activities in terms of productivity. If you look at the top 5 sectors, you see the agri sector that contributes about 22.9%. You look at the ICT about 18.6%. And you look at trade, that's contributing about 8.6%. And manufacturing, I think about 5.6%. So you would see that like the top 5 sectors that are contributing about 73% to the total GDP are non-oil sector. The industrial, the oil sector, we know that because of oil theft, divestment, is really affecting production. Based on the statistics, I think within that quarter, oil production was around 1.4 million barrels per day, compared to the OPEC quota of 1.8 million barrels per day, and what is also in the budget, which is almost, I think, about 1.8 or 1.9 million barrels per day. So you would see that we are not, in terms of the economy, we are well diversified. But when you look at projection, the budget projection, we always depend on revenue from oil, and now it's not coming in. The CBN also depends significantly from revenue from oil beyond sourcing using Eurobonds and other multilateral agencies. That's like the main source. So all those revenue, those value that we extract from that sector, is we are not benefiting from it, and we are also paying subsidies. So it's like a double whammy. You are not getting the revenue, but you have to also subsidize oil, subsidize PMS. So that's a major challenge. And when you look at the non-oil sector, you would see that when you look at our tax to GDP, it's still very low. I think maybe around below 10%. So in terms of even extracting value from that, so if we are not able to extract value from from our activities, it's really going to impact or limit how much of development we can achieve, because when you are going to build roads, it's not based on GDP. When you are going to pay salaries, it's not based on GDP. Pay your the service debt, not based on GDP. It is the value that you extract from that GDP in terms of income that you'll be able to make any meaningful impact and achieve a good growth.
So I guess it's time for us to start really diversifying our revenue. But my attention is also drawn to this air transportation. Air transportation grew by over 22%. And this is the second quarter. And I'm trying to remember, does it mean the impacts of, the aviation fuel scarcity, obviously the threats of some airlines to withdraw their services, international airlines, and even the closure of some of the local airlines has not been captured yet?
Okay, thanks. I think that starting from your last question, yes, the closures started mainly in July, August, which was not captured in this. But there's also that base effect that we can lay hold to for that sector. So look at last year, the economy was just that sector was just opening up on the back of the restrictions that we had even globally. So that is responsible for that year-on-year growth that we are seeing of 22%. But we know that the challenges are also enormous. So when we come into looking at Q3, we believe that it will slow down, because with the increase even in airfare would also reduce the usage, and that is really going to impact on the activity. We know that jet fuel has also increased significantly, so cost of doing business is significantly high in that space. And we know government, based on the report on Friday, trying to resolve the ban, the suspension we're seeing from the foreign counterpart. So with that is also really going to impact on the growth for Q3.
All right, and then another one is, okay, let's look at the sectors that contracted, and majorly we have the oil and gas. We saw that the highest contraction was oil refining at about 42%. That is obviously a major source of worry to the country. We've been talking a whole lot about oil thefts, but the Chief of Naval Staff was on one of our shows and was used on the news at 10 yesterday, and he said the numbers brandished for on oil theft is higher than we think it is. But how do we explain this contraction of oil refining by a whole 42%?
Okay, thanks. And like Professor Soludo will always say that you don't argue with numbers. So even if based on the official data now, we can see that there's really a challenge within that space. So whether it's not up to the amount that is being paraded, but we know that there's a serious challenge. We also note that the CBN governor has also alluded to that in terms of the effects that is coming in from oil, it has reduced significantly. NNPC has also mentioned that in terms of the revenue they also get, that has also reduced significantly. So it's really that we need to solve that problem, because this is this era where oil prices is high. We're supposed to be benefiting as a nation from that high oil prices. Yes, prices are moderating, but we still have a lot to benefit from it if we're able to solve the issue of oil theft. And most times when you look at it, this oil theft, it has to be like a syndicate. This is not something that you just steal and run. So we need to be sincere and focused on how we want to resolve this if we want to move forward as a nation. And we want to, because it's impacting on effects, it's impacting on government revenue based on debt to actual revenue was at over 100% in the first 4 months because the oil sector also lagged behind significantly. I think achieved about 24, 32%. So it's really the data have just buttressed the major challenges we are going through within that space. Because when you look at projection for the budget, oil revenue most times will account for about 30 to 40% that we're expecting. But if that part is not coming in, it means that we have to borrow to fund that particular part. But beyond even government revenue, it's creating instability in the FX market because it reduces the ability of the CBN to also supply. Because if they are not getting, when you look at the external reserves, the major bulk of inflow that the CBN have seen is based on euro bonds. I think about 8 billion, 6.25 billion dollars that have come in. So it's something that it's a major issue that the government needs to look at if we are sincere that we want to solve this problem and reduce the pain Nigerians are going through.
And then there are some sectors that economists such as Dr. Muda Yusuf have noted that they are still in recession, like textile.
Okay, thanks. You know, for textile, when you look at it in terms of the production, local production, it's really not picking up. And for those that are even importing, there's that impact of FX, which is that major focus would also impact on them. So it's a sector that government also needs to focus on because it's also job elastic. It can produce a lot of job. I know there was a time the CBN was trying to support the cultivation of cotton, which is a major input into the textile industry. So if this industry can be overhauled, it's really going to create significant employment. And we look at it, if government decides and wants to supply uniforms to pupils in Nigeria, and government funds that, yes, we may say it's a form of subsidy, but it's really the multiplier effect will be enormous. It's going to be very significant, such that the number of jobs that it will provide, and that money is also going to stay in the economy. And over time, even if the pupils have to pay for the uniform, but it would have stabilized that economy because the number of industries that would have been set up, the number of production and standardization over time, because what we always complain about is the quality may not be as much as what is produced, but over time, once they see that there's consistent demand, then based on technology and improvements, research and development, they will be able to improve on the quality. So it's also a sector that is very strategic, that can also help and also even generate effects because we can export those materials and earn significant effects.
Yeah, well, talking about quality, of course, that will come there. Just before we let you go, Mr. Ebo, what's your outlook for Q3? When we look at the parameters, we have strived in the face of a surge in inflation. But, I mean, when we look at, for instance, aviation sector, the challenges there, oil theft also, what do you see at the end of Q3?
We still feel that, yes, we'll still grow above 3%. But like I said, that's not the optimal growth. So rejoicing that we're in positive, it's really not a major issue, not the problem that will grow above 3%, but we need to begin to focus on growing at least about 5 or 7% for us to have any meaningful impact on the economy. So yes, we still expect a positive growth in the third quarter. The PMI data, that's the Purchasing Managers Index, even for July, I think it was around 53 points. So the manufacturing sector obviously will grow, and that would also have much impact. And depending on how much of the intervention that we would see within the oil sector, so their production can increase, that would also have a major role to play in the final figure for third quarter.
I guess, Mr. Ibe, one of the reasons Nigerians are celebrating is in the UK. They've not been recording growth for some quarters now.
Yes, I would like to come in there. When you are comparing the growth rates, they have already marked, you know, when you get to a level, the rate at which you grow reduces. We are still developing. So our growth rate needs to be high. When you look at China, before COVID, you see that growing at double digits is because they are just expanding. So it's not going to be apples for apples when you compare our growth rate, even if they are growing at 0.5%. That's massive because based on the current level where they are developed, they don't need that much growth to achieve that level. Compared to us, there's still a lot of potential that we need to tap, and that we should be growing even at double digits if everything works the way we want.
Yeah, talking about one of the factors of an emerging economy. Thank you so much, Mr. Abel, for your thoughts this morning, and enjoy the rest of your day.
And you too. Thank you, Bobby.
So a caution there that let's not celebrate too much, even though we're growing, and countries like the UK seem to be going down the route of recession. We'll take a break now. When we come back from that break, we have a report on the banking sector in Nigeria. You want to find out how safe your money is? Join us for that conversation after the break. This is Business Morning on Channels Television. Welcome back. You're still watching Business Morning here on Channels Television. We head straight to the banking sector in Nigeria. And we start with the findings of Augusto & Co. They note that there's been positive resilience shown by the Nigerian banking industry in the full year 2021 as the industry's loan portfolio grew by 21%. And that's despite the weak economy and regulatory constraints, and return on equities at 23%. We have joining us now Ayokunle Olubomi, Head Financial Institutions at Augusto & Co., to tell us how they arrived at this and what this means. Good morning, Mr. Olubomi. Thank you so much for joining us this morning.
Good morning. Thanks for having me.
Yeah, so tell us how you arrived at this positive resilience by the banking industry in Nigeria.
Okay, thank you very much once again. And if you notice, 2021, we saw a rebound in the economy, right? With the scale down of the restrictions that we had because of the pandemic. And this was reflected in the banking numbers, right? And we also saw in 2021 a better understanding of the operating terrain by the banks. So what we realize is that look, the industry loan book grew by over 20%. Not only that, the bank leveraged the increased acceptance of electronic banking channels by Nigerians and grew the electronic banking income by over 60%. Right? The investment income that typically dominates the bank's non-interest income was also resilient in 2021. Overall, the non-interest income grew by over 30%. The banks also maintain a lead on costs, taking lessons from what we saw during the pandemic. The cost savings that the bank recorded during the pandemic in 2020 continued into 2021. So although on absolute term, right, the industry's operating expenses grew by 11%, but the cost to income ratio, right, which shows how efficient the banking industry is, right, actually even dropped by 200 basis points to 64%.
Okay, but can't we say that, I mean, we're looking at 2021 now. 2020 was a very peculiar year. You know, can't we just put this as a base year effect?
Not only that, right, because remember that the income is also for a period. Right, so it's not only about because if you check the performance on 2020 wasn't that bad. 2020 wasn't that bad in terms of the income. Remember also that for the bulk of 2020, the banks were shut. The branches were closed down. People were working from home. So the banks recorded a lot of cost savings. So that's why you can realize that in 2020, relative to 2019, the result wasn't that bad. So what the bank actually did, the banks were already under pressure because costs were actually even going. We're actually using this to increase their income.
All right, so your findings at the end of it, you're forecasting a 23% return on equity at the end of this year. That should encourage investors into the banking sector, right? Or is it too late? Is it too late to get in?
I will say yes. I will also say no, because despite the expected improvements in the industry's ROE, but also don't let us forget that the headwinds in the banking industry is actually still there. The cash reserve ratio is still there, and we all know what inflation is actually saying. Look at the energy sector; we could see the high cost of energy. So the challenges are still there. And don't let's also forget that this is looking at industry-wide. Some banks will actually record more growth, while some banks won't do as well as others.
And then you anticipate 16.5% year-on-year loan growth this year also. Have you taken into consideration some of these factors you just mentioned, the headwinds?
Yes, I think like I mentioned earlier, what we are saying now is that most banks are having a better understanding of the operating terrain. Because as a bank, whether you like it or yes, you have existing shareholders that you need to deliver returns to, irrespective of the headwinds that you actually have. So you see most banks looking for opportunities to make income despite the prevailing headwinds. Right? For example, in looking at the loan book, we believe that the loan book will actually grow by over 16%. Why? Because despite the headwinds, banks are looking for opportunities. For example, if I tell you like 5 years ago, a lot of banks will tell you that they don't actually lend to the agriculture sector. But what we've seen over the years is that almost all of the banks, even the most conservative, they are looking for where are their opportunities? Where are the ones that we can even align the opportunities to our what? To our risk acceptance criteria, right? For example, like I also mentioned to you, banks are also focusing on electronic banking income and even agency banking. You will notice that a lot of banks are even now focusing on also looking at the profitability of branches. The branches that are not making profits, they're closing it down. The one that they couldn't close down, they're scaling down operations there just to be able to focus on efficiency and how to even make more money.
And we hear banks are also collaborating with fintechs these days.
Yes. What you see is that for most banks, right, the strategy around fintech has to do with collaborate and compete. So meaning that in as much as possible, can you collaborate with the fintechs, right? And areas in which you can compete, you can also compete with them. Because the fintechs also realize that, look, they can't run this show all by themselves. The banks have been here for decades. They understand the terrain better. So most of them actually, so it's a win-win situation for most parties, for both parties.
Well, you hinted on this earlier, the cash reserve ratio being high at 27.5%. I mean, a lot of people have talked about this, but of course the CBN also has its own vision and plan, placing it at this point. But what impact is this 27.5% CRR having on the real economy?
Yeah. Okay. First of all, looking at it from the banking industry, if you have any bank MD now, they will tell you that one of the greatest challenge, if not the greatest challenge they're having now, is the cash reserve ratio. And a lot of banks in top management, they dread Fridays where you have the CRR debits, right? And because let's forget also that the banking industry is basically in the business of financial intermediation, taking money from the surplus and also giving to the deficit. So out of the money that you're taking from the surplus segment of the economy, if a portion of it is held sterile by the CBN, under the guise of the CRR policy, what you realize that the amount of funds available for the banks to lend to the real sector will actually reduce, right? So although the growth that we saw last year and the one we are projecting this year, without the CRR, the growth will have been significantly higher than that. So number one, like I mentioned, is going to reduce the amount of loans that is going to the real sector. Don't let's also forget that the CRR is held sterile by the CBN, meaning that bank hands no return on it. Even the special bills that the CBN give to the banks, realize that the interest rate on it is actually very, very negligible at 0.5%. So what we see also is that for the loans that the banks are giving us, for the other opportunities to actually lend and make money, banks are actually maximizing that. So that's why you realize that in as much as possible, you see that the fees, charges are low, right? It's also going to be higher, right? Because the ones that the CBN is holding sterile, don't forget that some of these funds are also purchase funds. I need to pay interest expense on it. So as a bank, the ones that I'm lending now, I need to try and even maximize what I can actually even get on it. So you see that the cost of banking, the cost of banking to the general public is also going to be higher because the banks are trying to even maximize income from the available sources.
But I guess the CBN also has inflation to deal with, so they also try to mop up some of those cash from, from the economy to balance things up.
Exactly. Yeah, I agree with you, right? Because I agree with you that the CBN, at least they know what they're actually looking at. They're looking at inflation, also looking at the exchange rate. But at the same time, the banking industry is on what? Is on the receiving end of some of these policies.
Yeah, but I guess they can balance that up with this hike in the savings deposit to 30% of MPR. You think that will encourage more funds to go to the bank, more savings, and make a change in all of this?
Yeah, looking at the increase in the savings rate is a two-way thing. There are two ways in which you can look at it, right? One, some might argue that it can encourage savings, but let's even think about it. At less than 5%, where you have inflation of about 19%, I don't think it's going to be that significant. But what you also see is that for the banks existing savings stock, savings deposit stock, you notice that the interest expense on it is going to increase. But having said that, what we realize is that for most banks anticipated higher interest expense in 2022. So most of the banks have actually factored that into their plans, right? So we don't expect this this increase in savings interest rate to actually even significantly adversely impact the banking industry. Let's also not forget that in terms of the intervention funds, right? The income on it, the interest income on it was also increased from 5% to 9%. So the bank will also make money from that particular aspect also.
All right. So with this now, if we were to have this conversation early next year, what do you see? Do you see a stronger, more resilient banking sector, or do you think some of these factors will taper that growth trend?
Yeah, if you look at the banking industry, like I mentioned earlier, a lot of them are having a better grasp of what is happening in the environment, right? And then let's also not forget that this is a cycle that we've actually seen over the years, right? The challenges with FX. Don't forget, we're also here in 2016, where we had the issues with FX, then when we had higher inflation, right? So it's a cycle that the industry has actually even passed through. So to answer your question directly, yes, we think the industry is going to be more resilient. And let's also not forget that a lot of banks are also trying, those that think that they need to shore up their capital, they're actually even putting up different initiatives to raise capital, either as tier 1 capital, either as additional tier 1 as perpetual bonds, also tier 2 capital. Right. So you see that a lot of banks are also trying to even create enough buffers and putting up different initiatives to ensure that they're actually resilient and they actually prevail relative to given this particular prevailing headwind. So to answer your question directly, yes, the industry has resilience, and we see the industry to be more resilient in 2020 by this time next year.
All right, it's good to know my money is safe in Nigerian banks. Thank you so much. All right, that was Ayokunle Olubunmi, Head Financial Institutions at Augusto and Co. Well, let's take a break now. After the break, we'll head to the market. It's good to know that Willie Bong is back. We'll be seeing her face in a couple of minutes. Stay with us. This is Business Morning on Channel 7. On Channel Television, head to the markets now. I mean, the equities market last week gave us a surprise, like a big surprise. A lot of analysts didn't see it coming. I don't think I did, but incidentally, Anietie saw it coming, and he did mention that. So we saw 3 positive days, but I know the week ended in a positive, which was something to celebrate for some of us here. But good to have Will. Will has been on vacation, enjoyed herself, looking so fresh and fine.
It's good to be back. It's good to be back.
I'm welcoming you to the new studio. This is your first time here.
This is my first time, and it's great to be here. But I want to say the market really performed last week, and we saw, as you mentioned, Anietie saw it coming. We saw.
We call him the prof now.
Yes, 3 positive close to end the week, and then we saw 2 weeks losing streak before we had, it halted last week.
No, I've been following for 3 weeks. We always had 1 positive trade in a week, 1 positive trade. So when we had the first positive last week, I was like, oh, the norm. Then we had more than 2%, I think, on a particular day, and gained about 460 billion naira. I was like, no.
It was mind-blowing. The market is really surprised us this week, and we saw 0.63% gain. But before that, we're going to jump in first to the FX market and tell how that ended for weeks. We'll start off with the Forex reserves, where it recorded an accretion for the 2nd consecutive week, as it grew by 34.69 million naira week on week to 38 38.95 billion naira as of August the 25th. Similarly, trading activity in the forex market ended the week positive 88.45%. That's the increase we saw last week, and we also saw the FX spot market up 56.32%, and that contributed largely to the total overall transactions that we saw, the positive close that we had for the FX market. Transactions at the derivatives market, we saw a positive close to up 212%. That is a big jump for the derivatives market, and this was largely due to the jump in the futures market. We saw that up 306.52%. But the forwards market was down 11.37%. We're wondering what really went down there, but our analyst is going to give us a bit of an insight into that. Now, looking at the FX spot market, we're seeing that transactions are really rising there, but now we look at the FX rate now. We saw the Naira, the local Naira was up 0.03% last week to close at 427 Naira 81 kobo as against 427 Naira 94 kobo that we saw in the previous week. We're seeing that the Naira is struggling with the dollar, and especially now that the dollar is strengthening in the global market. Globally, every other currency is looking undervalued compared to the dollar. The strengthening of the dollar is really affecting, especially emerging markets, and Nigeria is not, it's not spared from that route. Now, despite the sell-offs, we move on to the fixed income market. Despite the sell-offs that we saw in the fixed income market, within the bond space, well, it didn't escape the sell-offs that we saw there. Bearish sentiments persisted in the bond space. We saw a massive sell-offs in the 2032, 27, and 2042 paper. 2024 paper was not spared as well. 10 deals recorded total value 3.93 billion naira. But likewise, in the NTB market, as the Treasury bills market, apart from the fact that we saw sell-offs, the NTB market managed to close a bit bullish for the week. We're wondering what happened there. The analyst is going to give us insights into that. The OMO segments was similar sentiments also persisted there. We saw 11% rise, 10% rise. That's big for the fixed income space, and investors are going to be taking a lot of money home, and a lot of return for their investments, and lots to talk about when they they gather in their forum. Now, Odinaka Linus Nwonkokwo, fixed income dealer, Access Bank, is here to talk to us about that. Good morning, Odinaka.
Hi, good morning, Will.
Odinaka, we saw a jump. We're going to talk about the FX markets, about the jump we saw in the FX space. The total derivatives markets rose thanks to the futures. Are we seeing new future contracts come in, or what's happening there?
So what I can say is that there's really no inference you can draw from the jump in futures market. So what you're getting to see is just a counterparty trying to hedge their trade obligation. And mind you, like you said, the forwards and the futures are the two most derivative transactions that you see in the market. So considering the uncertainty in the FX forward, so counterparties are not willing to provide those guarantees because there's actual delivery of dollars when you do a forward. But in terms of the futures market, so it's in local settlement, local currency settlement, which is the Naira, so which is guaranteed by the central bank. So that's why you see people playing more in that space than in the forward.
Okay, so given the inflow, what we're seeing now, the fact came in last week. We saw disbursement of over 900 billion naira. It's expected to hit the system this week. Or what do we expect from? Are we going to see a lowering of yields, especially in the Treasury bill space, the bond space? What's going to happen there?
So what you've seen currently is a kind of a bearish trend in the bond space. And I don't see that changing for now, considering where you look at inflation at 19.64. So you continue to see those sell-off despite the fact inflow. Also remember the market was in a repo of about 123 billion as at Friday. So we are trying to plug in a hole when you see those fact inflows coming. So we don't have excess liquidity to move into the market to stimulate a buying trend.
Thank you so much. Odinaka Linus Nwonkokwo, fixed income dealer, Access Bank, for those insights and share your perspective on the program. Thank you so much. So, Ini, that's what we have for the markets. The fixed income space is still bearish. We're seeing sell-offs everywhere. Investors are selling off the market. Right now, it's more like, what can it sell to make more interest? Because as yields are rising, they want to get more return. Yes. So if everyone is selling at the highest bid that they can get.
Well, if you were an investor, Assuming you're not. I know you want to make money. Oh, well, thank you so much for the market. I will switch over now to the crypto space. And, Laddie has gone on his vacation, so I now have that responsibility to take you through the crypto space, at least until he comes back. And there we see, looking at the numbers there, if we take it to the numbers to see that where the fair greed is not looking much better. It's worse actually compared to Friday, because by Friday it was at 27 and now it's 24, so it's still extreme fear. Doesn't look like the market is recovering. If we'll move over to the market cap now and see how that is looking this morning, but I do know that on Friday the market cap was at 989.44 billion. If we would have the market cap, please, to know what that is this morning, and also the 24-hour volume, it's down this morning. Since I don't have it there, 24-hour volume is down 7.31% compared to yesterday. It's at 56.3 billion. Market cap at 954.3 billion. Okay, there you have it. And as the price of Bitcoin is down, it was about 24, I think, on Friday. But this morning, there you have it, less than 20,000. A lot of movement that we cannot really explain on the market. But not just this market, even though the equities is doing so well, as we just discussed with Will, but not like that for some of all the other markets. The price of Ethereum is also down. We're supposed to have Rume Ofi joining us this morning. Okay, but I guess it's not ready. But the price of Ethereum is not safe also. It's also dropped by 2.54%, and 24-hour volume also dropped. And by Friday, it was about 21 by 31 billion that we see there. And then the top alts by market cap is still the same as Friday, BNB, EDA, and all of that. We have Rume now. Hi, Rume. Good morning. Good to have you, even though the market is not looking so good.
A wonderful morning to you, Ini.
Yeah.
Thank you.
All right. So we saw a correction in the market on Friday. Can we say that the MTGOX fog is it back?
I think what happened on Friday was just a reflection of the 8 minutes address by the U.S. Fed, Jerome Powell, that actually sent shockwave to riskier asset market, and the big Bitcoin and cryptocurrency market is not immune to that. We saw about 2 trillion wiped out from global stocks, and the entire crypto market, which is what this about 1.25 trillion dollars was wiped out from U.S. stock, which is even bigger than the crypto market. So that actually sent shockwave to the market, seeing the price go below 20,000. There's a lot of challenge going on in the world, and we're going to hopefully see better days ahead. And this week is very, very significant, because you'll be seeing in China, the PMI figures will be coming out on Friday, on Wednesday. Then on Friday, the U.S. jobs going to come out. Then also Europe is actually expecting inflation figures. All of these things put together has a way of pricing it into the crypto market. And hopefully we're going to see something better, but I believe the floor is not yet.
All right, Rume, I wish that the crypto market would be as resilient as the equities market. We noticed that the equities can stand some of those shocks or is unmoved. But thank you so much, Rume. Ofi, thank you so much for sharing your thoughts with us this morning.
Thank you very much, Ini. It's a pleasure.
Well, that's it. That's where we can stop for now for today. But we have a fresh episode of Business Morning tomorrow, where we'll do more crypto, more equities, more fixed income, more conversations. That'll be tomorrow. I'm Ini John Mekwa. Enjoy the rest of your day.